Hello, everybody. This is Saurabh. Thank you for joining this session on the Options Engineer channel. Before I get started on this session, I want to ask a simple research question. Imagine two historical studies. One wins nearly 88% of the time, the other wins about 54% of the time. Which one would you choose? Most traders, including me years ago, would naturally be drawn to the higher win rate profile. But this comparison shows why that first instinct can be incomplete. When we stop looking at individual deployments and start looking at weeks, months, quarters, and long return horizons, the picture changes. The Iron Condor wins more individual deployments, but Skyline Butterfly version 1.0 shows stronger monthly and quarterly consistency in this historical study. And the return by horizon view tells a very different story. This is why this comparison is worth studying. The higher win rate study was the 25-point Iron Condor. The lower win rate study was Skyline Butterfly version 1.0. In this historical comparison, the lower win rate structure produced stronger long-term performance. This does not predict future performance, it simply shows that win rate is not the full story. Before comparing any option strategy, I first want to understand how much capital is actually exposed. Premium paid is not always the same as risk, and premium received is definitely not the whole story. Capital at risk gives a more practical comparison lens. It will vary with time to expiration, volatility, skew, and pricing, but it is still the right ballpark measure to compare unlike structures. For the historical study, I use a simple practical comparison. Two Skyline Butterfly version 1.0 lots or contracts versus one 25-point Iron Condor lot slash contract on SPX. I do not want to overstate this as a fixed law. CAR varies with the market conditions. But for research and presentation purposes, this is the right ballpark and gives a reasonable approximate CAR comparison. Here is the study in 1 minute. Same market, SPX 0 DTE. The comparison is Skyline Butterfly version 1.0 at two lots versus a 25-point short Iron Condor at one lot. The research window used approximately 433 paired deployments from July 2024 through July 2026 with a 9:45 a.m. Eastern entry and hold to expiration research assumption. This is approximate CAR alignment for the study. Live CAR, that is capital at risk, can vary, but this is the right ballpark for the research comparison. The answer is not one magic metric. It is a combination of payoff geometry, capital efficiency, and how the distribution of outcomes behave over time. That is what I mean by engineering the payoff distribution. Now I'm going to move into the options engineering platform. The goal is to show CAR, payoff geometry, and structure comparison together in a visual workflow. This is the engineering view before we move to the historical backtest results. So here I am on in my options platform that I use to design different structures. What I'm trying to compare here is two different structures, the Skyline Butterfly 0DT 1.0 and Iron Condor. You can find more details on Skyline Butterfly 0DT 1.0 on my website as well, theoptionsengineer.com. So as we look at the four butterfly structure here, what we can see is the capital at risk is $1,500 and model peak profit is $2,500 for two contracts. What I have tried to do is to normalize the capital at risk with the capital at risk of Iron Condor, that is 1765, and the model peak profit of 735 for one contract. So it's not one-to-one match, but the capital at risk is slightly less on the Skyline Butterfly 0DT 1.0 with two contracts. One thing you would note here is that the debit paid is more than the Iron Condor, but the capital at risk is less. The debit paid is $2,500 and for the two lots, and for the Iron Condor, the debit paid is 1765. So this is where when I mentioned earlier in the presentation that capital at risk can vary, and the premium paid for a debit spread or the credit received can't tell the full story. So you have to dig in a little bit more deeper to understand how things are structured to get the right understanding of the where the capital at risk stands. Now let's look at some historical data for the last 2 years and then last year and year to date to determine how the two structures have been performing. So I'm going to share some data from option Omega, which is a option backtesting platform, and they have a significant amount of SPX data to compare against. So here, let me just actually start with Iron Condor first. So we can see with a 2-year period, the results from Iron Condor were for starting capital of 5,000 and one contract deployed every, or one lot deployed approximately every day. The returns were $22,000 approximately. To look at the overall graph here, we can see based on the graph, the returns were had some bumps along the way as through the last 2 years, and there were some level of drawdowns. The drawdown here might be a little bit more magnified, which because of the less capital, and that's what you will see in the Skyline Butterfly version 1.0 as well. But as if we increase the capital or reduce the number of contracts using XSP, then the drawdown will come down as well. So now let's look at the Skyline Butterfly 0DT version 1.0. Here we can see that for the same amount of capital in starting capital in the account and same amount of capital at risk that I shared earlier in the engineering view, the returns as per the backtesting were significantly higher, 68,724 PNL here. And we can also see that the graph is slightly more or quite a bit more smoother than the Iron Condor graph of the progression of how the capital is compounding here. Now let's look at the 1-year chart. So I'm going to select 1 year. And for 1 year, Iron Condor had $12,714 in profits. For similarly, let's look at for 1 year, how was the return? For Skyline structure, for Skyline, it was $33,000 in profit. Now let's look at the year to date. The year to date for Iron Condor was 7,400, and for year to date for Skyline was $18,496 here. So kind of the key summary here is that the Skyline structure, obviously based on the data we are seeing here, did perform better in the backtesting. There's no guarantee of the future results, but this backtesting shows the structure does work in the last 2 years. Also, the other key aspect here to look at is that there has been a lot of volatility and headline-driven aspects, which has caused stop losses and drawdowns to happen in some similar strategies, in income-generating strategies in SPX. The one thing that Skyline Butterfly version 1.0 0DT has been able to show here is that it has been able to withstand that volatility and by holding till expiration. So the key aspect also here is that this strategy is to hold till expiration. So once you open this strategy per the guidelines, then this just needs to be held till expiration per the back testing results. So that's the kind of some of the key aspects here. So this is the core of options engineering mindset. Stop comparing strategies only by their headline return or win rate. Start by comparing risk, then study payoff geometry, then study the outcome distribution. Only after that does the strategy become easier to evaluate and potentially easier to hold. Skyline Butterfly version 1.0 is one example of applying this engineering approach. The broader goal of options engineering framework is to provide a repeatable methodology for designing, evaluating, and improving option structure through historical research and disciplined risk analysis. If you found this helpful, please like, subscribe, and leave a comment with topics you want me to cover. You can also visit the optionsengineer.com for research updates, educational case studies, the options engineering blueprint, and coaching related resources for traders who want a more structured way to think about option strategy, design, risk, and trade process. Thanks again for watching, and I will see you in the next video.